Don't let the candlesticks create that emotion and make you not see the market for what it is.
Greed will consume you. You want to be in the market. You want to take these trades. You want to react impulsively. Pretend your job is not the trader, but pretend your job is the hunter.
Sniper.
And a sniper. Your goal is to find where those stop losses are.
You want to see liquidity as basically the catalyst for a trade to start. It's so important. It's such a game changer if you really understand this. You can have the patience of a saint. What have you got patience for? You don't know what you're waiting for.
What's going on, guys? And welcome back to another whiteboard video. And in this video, we're going to be covering a very common trading topic and a very common trading issue, which is stop losses being hit. Now, the reality of trading is your stop loss is going to be hit throughout the entirety of your trading career. You cannot escape it. It's going to happen irrespective of how good you think you are as a trader. It happens to the worst of traders in the world a lot of times. It happens many times still to the best traders in the world. What we're aiming to do in this particular video is help you try and reduce the frequency of that stop loss being hit, and simultaneously help you understand why your stop loss is likely being hit more than you really want it to.
Yeah, so this is my first whiteboard video and jumping on with Tori to do these. We were trying to think about what the best topic would be, and we thought long and hard and thought, you know what is everyone's biggest issue? And obviously that is your stop loss getting hit. So we thought, let's combat that and see and start breaking it down and explaining, you know, how we place our stop losses and how we reduced our stop losses getting hit so much, and try and give you some help so that you can reduce those, like Tori just said. So from my point of view in the Forex market, and what sort of got me the sniper entries that I'm known for was at the very beginning of my trading in the first few years, which we all are at that level at some point. We all sort of learn the average retail trader mentality where everybody sort of trades the exact same way and they all look at the charts in the same way. You know, they'll enter because they've seen a formation like a double top or a double bottom. They place their entries in the same place that everybody places their entries, and their stop losses in the same place. And at the beginning, I was doing that. You know, you have some wins, but you have a lot of stop losses being hit. And it's only after you go through a few years of that procedure, you start to look at those stop losses and think, well, why are they getting hit so much? What can I do to change this and reduce them? And what that process was is what we're going to start showing you today. So for me personally, again in Forex, is as explained, and I'll show you a very, very common formation, which is actually happening in charts with the dollar index at the moment. But you see this on all time frames, on monthly, weekly, daily, 4 hour, 1 hour, on a probably daily basis on the lower time frames. But I think it's probably one of the most common formations that you'll see is a double top. Now everyone looks out, all retail traders look for a double top or a double bottom. So I just draw on a double top at the moment. And one of the biggest problems that retail traders have is they see the second point on a double top, which I'll draw out, and immediately think that that's resistance. So what happens here, a normal double top is you have point 1 and price will come back up to point 2. So most retail traders, before I even draw that on, most retail traders, the issue is they're thinking that that is resistance already, because they look left on the chart and they see that there's a point over here, a significant high. But that doesn't mean resistance. Resistance isn't created until point 2. This is very, very important. So as price is coming back up here, a lot of retail traders are already looking to this prior point and expecting a double top, or thinking in their head that this is an area of resistance. This isn't an area of resistance. Price has fallen from there before, but in order to create resistance, we have to make that point 2. And once we make that point 2, this is where the double top, the most common formation that I would say that you see in the market. But literally, once you understand this better, it can be a massive game changer. Because once price starts moving away from here, retail traders straight away think that's the double top, and they start looking at where they can sell this. Conservative, or most retail traders, especially when they first start trading, is they'll wait for price to come back down and break this level here, and they'll enter here and put their stop losses up here. So, you know, there's other retail traders might not enter here, might enter when, you know, there might be a certain candlestick formation, usually an evening star formation, which you can draw out afterwards. Once they get a bearish engulfing candle here, they might start entering here. Again, stop losses up here. There's various different entries within here on the retail trader mentality, or the retail traders, how they look at entering a double top there. But on every single scenario, the stop loss is going up here. Now, what we explain to members, and what we rarely ever do, is trade from point two. Because as I've just said, in Forex, every single scenario we've just spoken about, the stop loss is being put up here. So if 90 to 95% of retail traders' stop losses are getting hit, it's because they're all being placed in the same place. Whereas if you don't take that trade and you wait, it's getting very badly drawn, excuse my artwork, but if you have that double top here, the important thing to remember is there is no resistance until point two. So let point two be made. Don't have the fear of missing out when price is moving away, no matter how far it gets, whether it's that bearish engulfing candle, whether it comes down here to break that next support, because the more that this turns bearish, the more liquidity comes in above here. So if you can be patient enough, and this is just one very minor thing, but it's so powerful. If you can be patient enough, I would say 7 or 8 times out of 10, price will go up here to hit those stop losses, and then that's where you want to be entering the market. Very simple, broken down in just a few minutes, but that there is such a powerful tool where 95% of retail traders keep getting stopped out. Whereas if you don't enter on that second point and allow the market to move away, also happens the same thing with a double bottom. But this is how support and resistance really works. Most liquidity is always set up here, so you're just simply waiting for price to move away. Don't get the fear of missing out. However bearish this is, remember the market is making this as bearish as possible to make you want to jump into the market and put your stop loss up here. And everyone in the market, except most retail traders, as mentioned, you know, the most obvious thing to be able, the easiest thing to be able to spot is a double top in the market. And so then everyone rushes to put their stop losses up here. And then whether it takes a few hours, a few days, even a week, depending on what time frame you're on, you know, 4 hour, daily, weekly. But if you can have the patience, which is, again, why your stop loss keeps getting hit. One of the big reasons is not having patience. Because when that move happens, it's very hard for retail traders to sit on their hands and not wait. If you can have patience and wait for that next drive up, that third drive here, that's where you can get your sniper entry and then get the whole move, and it happens a lot quicker rather than everything that happens in here.
Yeah, to add to that, I'd probably say one of the main things you should always understand is generally, if the market is going to make a major move to the upside, it's very likely going to be targeting long liquidations continuously in the crypto market. And what we're going to be doing in this video as well is kind of differentiating between crypto and Forex, but also showing the similarities. And essentially, the market will almost always aim to pursue all of the longs out of the market before it actually goes higher. It will always aim to pursue and stop out or liquidate every single short as much as physically possible prior to the major downside event. We could actually see something similar to this. If I kind of illustrate this, although you're very tall, I have to stretch to reach this, just to illustrate the same sort of thing that we covered in our previous video where we called the crash from 125K, which would be a pretty good starting point. The one thing you would have noticed is there was obviously a key high on BTC around the $125,000 region. And what we essentially did here was drive up and then have a massive move down, coming back to the kind of midpoint of the range here. Now, of course, the immediate reaction for most people is to sell. And once that big move to the downside comes in, there will be liquidations or shorts, stop losses starting to build up in these areas. Of course, the further down the market goes, the more the consensus begins to shift to the downside, and naturally everyone is looking for a bearish sentiment. But immediately, and one of the reasons why we said at that point in time, the key to seeing an actual move to the downside, you kind of get an idea already that the market could be preparing for a big move down. But what you will normally then begin to see, and also gives you reassurance to not just look for possible long entries, but it helps you stay calm. Like Bernie said earlier, the market will almost always come back. Unless it's a massive, and one of my rules of thumb is, unless you get a huge, time frames also play a role, which we'll get into, but unless you see a huge monthly or weekly candle that looks like this, obviously incredibly green, there is a higher probability that if the market has played around in this area and there's several wicks, it's likely a trap and luring people into the market. So in this particular area, you would have noted when Bitcoin drove back up to 125K, it drove up, essentially stopped out every single one of these shorts and also liquidation levels, which I'll get to. Thank you, Bernie. It cleared all of these stop losses first. And only at that point in time does the market then proceed to make new lows. Simultaneously, whilst that is happening, longs will begin to build in this region, where price has not yet come in to clear this particular low. So the same way a point A has been made there and a point B has been made there to create a low, there is essentially an empty void. Whereas always, the easiest way, what you must remember in trading is your opinions, your analysis, your setup, your bias, etc. It's not unique in any way, shape or form. And 99% of the time, why your stop loss is getting hit is because you're placing those stop losses or those trades with liquidation levels in crypto at the exact same areas as everyone else. The market is an incredibly intelligent entity or ecosystem, organism, whatever the hell you want to call it. The market is incredibly intelligent at making you react impulsively, especially at certain periods in time. So as the short liquidations would have been swept, that's already your indication the market is very likely going to come in and take out those individuals. But simultaneously, people going long in these regions would continuously be building stop losses all the way below these levels. In the sake of crypto, that would be the higher leverage positions, such as like 20x leverage, 50 times leverage, 100x leverage. They're all going to be just under the local lows. But if there's a key low below and price has not yet come in to trigger or at least liquidate that low, you know there's a much higher probability the market will come back. And this is why often you get that kind of kamikaze effect in the market, where both sides are taken out simultaneously, essentially. If the market pursues the upside first and wipes out shorts, it's going to come in and scatter those long liquidations after. And that's exactly what happened in this situation. Now, to expand on that further, something else to also consider here is timeframes. Now, if we apply the same concept again, just as an example of what Bernie said as well, and kind of piecing that together, let's say here, and one thing I've kind of noticed, and this is something you cover a lot as well, it doesn't always do it once. Sometimes the market can come back and take it out twice. It doesn't always immediately just go straight into a high, as an example. Let's say we drive up, take it out. It can often go in one more time, up and down like that. Now, I don't know why that is, to be honest with you, because it hasn't always been this way. And for me personally, many, many years ago, I don't know about you, but the market never used to do anything like this.
Well, in Forex, this is actually a little bit more common. And something that I teach members is the magic number 3.
Yeah.
Look, going back to what I just
I didn't
showed,
want to say the word in case you didn't want to reveal your secrets. But,
yeah. But going back to the last video, the magic number 3
yeah.
going up. But again, like sometimes, obviously what I just showed you with the double top, I just draw this alongside yours. But the double top is not always going to be exact. So here on that push through, sometimes it will push through a bit higher and come back down to give the illusion that maybe, you know, to some retail traders who might be a little bit more advanced, give them the illusion that maybe the liquidity's happened that I spoke about at the beginning. But this is basically a double fade away or a double whammy, basically. So it's basically tricking people to go long and short, rather than if we just had a double top, you know, that's only really bringing in the shorters because everyone's seeing that's a double top and the shorters come in. But the market will at times push through to bring in the buyers, then bring in the shorters, and then go back up. Again, takes patience to wait for that drive. But most retail traders don't have the patience and will jump in. So that is, in Forex, the difference between the two is you do get that a little bit more common compared to obviously crypto markets and what you're saying.
Yeah, but I've noticed it more in crypto recently as well. And I think the real explanation is people have just become a bit more savvy in the idea of stop hunts, etc. as well. I mean, if the markets, whether they are controlled again by very large institutions, which we know is the case, especially in crypto, but also I think just traders, retail traders becoming a bit more savvy in the idea of liquidations, etc. It kind of can go in for free drives now, because a lot of people now will know, okay, initial rejection, short. That would be the real basic understanding traders at surface level.
Beginner, intermediate, advanced.
And I think it's kind of a systematic journey where it's essentially like, right, wipe out the first amount of people here, clear them out. People will sometimes get bold and be like, okay, that's the liquidation. But what the market then does is go in for that additional drive. And it's normally at this point, it works in both ways. It actually destroys both people at once. Because what the market is then doing, every drive higher, it's destroying morale. It's essentially going right short. Okay, definitely a short for those that are more savvy, like Bernie said, intermediate. But once you get that final drive, that's normally the utmost confirmation that the market is going to reverse.
And the other reason as well, going back to what you said a few minutes ago, is the reason that's also happening is because you've got now a lot more liquidation building under here, because they've got a reason to think the flip side to the double top, there's now a double bottom. So they now think it's safe to put the liquidity there. And then as you've already drawn, that's coming down to take all of that out.
And so just to add to that, just to take the green one, because what you mentioned is a very good point. This is that double whammy I'm talking about. As this is happening, don't forget, in the eyes of most traders, people have a very surface level understanding of the market, which is, ignore my drawing or my writing, resistance, support. And it seems, whilst you probably know better, unfortunately, most traders still have that very basic level understanding of the market, where it's, single candle breaches that level on a 5-minute time frame. Especially in crypto, what you'll see is like a trend line like this, price goes down. I don't know if you can see that. Price slightly breaks like that, and people start posting those charts on X, and it's like, trend line broken, we are fucked. But that's not the case. But what's simultaneously happening here is, because people have that perception of the markets, it's also bringing in more buyers here simultaneously. So it's not just wiping out the shorts, but people that impulsively buy those breakouts there of the levels of resistance are simultaneously bringing in more stop losses and liquidations in crypto there as well. And this is what can often cause a liquidation cascade. And this is what often brings the market lower. And that again goes back to the crypto example of Bitcoin at all-time highs. It didn't just allow shorts an opportunity to get very confident and then take them out after, but it's also bringing in loads of higher leverage positions that are chasing those breakouts in anticipation of a move higher. So when the market comes back down and starts to blitz those, it often creates a liquidation cascade that brings them in to this level down below, where you've got these individuals with their stop losses there, and then you've got the longs that are chasing the breakout there. And what essentially happens is there's almost a pocket within the market of where there's a higher amount there and a higher amount there, and very little trading activity in the midpoint. So the market will then often breach through this, and that will lead the cascade all the way down as well. So the market is often pursuing every single person at every single time, and most don't realize that. You have to have a stronger understanding of the market. This is how trend lines work as well a lot of the time. That'll probably be something for a different video on the whiteboard, but the general basis is the market is never going to make it easy. Never ever going to make it as simple as that. It can do in stronger trending markets in certain circumstances, like a parabolic crypto market or fundamental driven news. But regardless of that, normally it won't look like these textbook examples, especially if a level of support or resistance is forming. And like Bernie said, you cannot base it off a single rejection or a secondary rejection. And what I'd probably add to that, or do you want to...
You've got the floor, sir.
Sorry, thank you very much. Let me just clear this off. The next point I want to make to this...
I'm just your helper.
Thank you.
What colour would you like next?
For now, I'll stick to black. I've got it, don't worry. Thank you. And then I'll let you take over from here. To add to that, higher time frames. Now, what most people do not wait for is the weekly and monthly closures. This is something we both teach, but I highlight a significant amount in crypto.
I think it's a little bit more tailored to crypto.
Yeah, I think so.
Weekly closes are important for Forex and monthly, but it's specifically very, very important in crypto.
Yeah, and it's something people don't wait for. And it's kind of going to tie into what I just said about people getting excited over a little break like that. So as an example here, let's just try and draw a realistic candle. Let's just say this is a weekly time frame and you've got the market moving higher. What most people,
No problem.
thank you, helper. Let's just say the market drives up into this level of resistance on a weekly time frame. What most people will fail to realize is, let's say this weekly candle has 3 days left to close. What most people will do is the minute that is broken, they will begin to buy. It won't look like a wick in that moment in time. This is very important to realize. What it will often look like on a weekly time frame is possibly something like this. A massive bullish candle that rips through that level of resistance. But what most people fail to realize is there is still adequate time for that candle to close. So what people do is the minute that starts ripping and it looks like it's at the point of no return, is they will shift down, as an example, to the daily time frame or the 4-hour time frame. And in crypto, I would say it's probably like 1 hour, 30 minutes, 15 minutes, etc. And what normally happens to that candle is by the time the weekly candle closes, it actually looks more like this, as a massive wick that then closes back below that level of resistance. And what happens in that area is, again, the people that chase that breakout basing the market on what the current weekly or monthly candle looks like. This is mostly applicable to weekly and monthly. It is frequent on the daily, but it's not as strong of a signal, to be honest with you. And again, what most people do here is, as this continues breaching higher, they buy every step of the way up. And what again happens in crypto specifically with those higher leverage positions is the liquidations literally begin from there. And within that candle is a scatter of stop losses and liquidations. So it's not just taking out the original shorts that have shorted from this move, let's say, that's then led to this particular candle. It's clearing all of those liquidations from there and stop losses, but simultaneously brings in a whole new wave of people. To illustrate this further, one more time before I let Bernie take over, sorry, it's just to get this fully understood on where a lot of people go wrong. So let's just say this is the daily time frame. There's a lot to draw and a lot to do. But let's just say this is daily or 4-hour. Daily to 15-minute, let's say, because it's applicable on all of them, 15M. This here would be the daily break. And what you'd probably see is a bunch of candles that begin to break through like this, or even just aggressively on a 15-minute time frame. So people would be watching that, and that's what traps them in, because they go, oh my God, psychological level, 100K broken, as an example, market's breaking higher. But then on what then happens eventually on the daily time frame is it slowly trickles down and then breaks through by the end of the day. And obviously on a weekly time frame, that would look something more along the lines of this. And that wick you see there, if I was to, is exactly that there on a weekly. Ignore my spelling and writing. That wick is this region here. So most people don't have the patience to wait for true confirmation. Yeah. And that's why I would say 90% of people's stop losses in crypto get hit alone, because they then wait for that. But simultaneously, because you know the market is probably only making its first real level of resistance in this region, that then brings in the shorters. So whilst it's trapped all those people in the market, the following candle can then drive up and take out this high. Because what then happens is more people go short off this candle and place a stop loss in this region. I would say the biggest take home is the easier it looks, the more likely it is to get stopped out. Like the more easier a setup looks, like a massive bearish candle, like you said, with the double top. You see that.
That's why I started with the double top, because it's something that's happening on the dollar index at the moment. It's the most clearest double top, and it's just obvious that the liquidity is above. Yeah. The more obvious a formation or setup is, the more likely it's not going to work. Yeah. So as a retail trader, whether you're in crypto or Forex, we all learn the very basic double tops, head and shoulders. And, when you go from a textbook onto the charts, it never works, because the market knows what the majority are doing and where they're placing their stop losses. So those head and shoulders can play out, the double tops can play out, but they get that liquidity grab first, which is basically what we're explaining now. So in the Forex market, it happens very similar to what Tori just explained, but there's another way it also plays out a lot of the time. And going back to previous videos we've done, the most manipulative candles in the market are the bullish and bearish candles. So in general, in Forex, the market consolidates a larger percent of the time than it trends. So if at any given time, the chart on one of the time frames, an hour, 4 hour, even daily and weekly, is usually within a range. I've done a YouTube video on this before on how to trade ranges, but pretty much all the time, the market is in a range for 80% of the time it's consolidating on one of the time frames. And once you understand what we're talking about now, support and resistance and how it really works, the thing about what we're showing you now is it's the most basic concept of trading. As you drew on a minute ago, the first thing you learn about when you start trading is support and resistance. It's like the ABCs of trading. But the killer on it is that's where, if you just understand how to trade it properly, the most money can be made. Because it does come down to something as simple as support and resistance, but just how it really works. Most people make trading so complicated and think it needs to be overcomplicated. But if you just understand the basics, like support and resistance and how it really works, and what we're basically showing you now, so much money can be made if you just have the patience and just understand how it really works. The reason I was talking about ranges and what I'm going to show you now is because obviously a range, a high of a range and a low of a range is basically resistance and support. But like you said, we're going back to the double top. Like when I see this and I see price move away, there is not a hope in hell that I'm shorting any of that. I'm just not, because I know for a fact, nothing's 100%, but 80% chance. And I'm happy to sit out. If price drops down the other 20%, I'm happy to sit out, because you know what? Sometimes the house has to win. Sometimes you have to let the market win without you, and you can't have the fear of missing out. But if I know that 80% of the time, price is going to go back up, especially when it's that clear, when you see an equal double top like that. If I know that 80% of the time price is going to go back up to take out that high, why on earth would I ever take the 20% chance of entering anywhere down here?
I'd also probably add to that as well. I don't know if you mentioned that earlier, but when that third drive comes through, once that point 1 and 2 is made, that's where it becomes so overwhelmingly evident to people, allegedly, that that's a clear level of resistance as well.
Yeah.
So that's actually where the most liquidity normally would come in from, because then you have a clear visible level of resistance when point 1 and 2 have been rejected. So people would look at that double rejection and be like, well, this is obviously resistance. They missed the first short, they missed the second short, the third time's the charm. And people see that and think, well, this is easy. It's clearly a level, and then it blitzes through. The market will always pursue the simplicity of it.
Yeah. So, with that double top, if you just open up your chart and actually take a look, get a range tool out, you'll see that the market, you'll be able to see a range and be able to show you what I'm showing you here and in previous YouTube videos. But, rather than drawing the top of a double top and the bottom, it's basically a range. And price is basically always moving from liquidity from one area to another. And as Tori mentioned, whether it comes up here and you've got the double top, there's so much liquidity here because there's so much eyes on the market. So support and resistance is, the best place is obviously to take a trade. I'll just remove this again, just so it's clear. Just because price has gone up there and gone down, retail traders think that that's a level of resistance. If you can get it into your head that that isn't a level of resistance. So if price is coming back up and trading close to here, a lot of retail traders are already thinking about selling in this area, but you can't. Remember, if price comes up to this level, badly drawn again, sorry, me being a bit of a perfectionist, but if price comes up to that level and then hits it, only then is it resistance. So you have to think, what is all the retail traders thinking? If price starts moving away, what is everybody thinking? That's the level of resistance, let me start selling. And that's why it's the last thing you should do is sell at that point. But going back to what you said, about the candle breaking through, what you get a lot in Forex is whether it's at this drive on the second, and you do get that third drive, this candle, I'll draw a candle on here, is usually a massive, big, bullish engulfing candle. And the reason being, very green.
Nicely done.
The reason being is because the retail traders who sell, they see that double top. So they see here and they see here. And this usually consists of a certain candlestick formation, but within that candlestick formation is usually a bearish candle down to bring in the sellers. So what normally happens when that liquidity drive happens, it usually happens in a very strong bullish candle. Why does that happen? Because anyone who's got stop losses here, who might think about holding on to that trade, will get scared because when this is usually even bigger, when this candle pushes up, and you'll probably relate to this, if you're short and you're thinking about holding on to a trade, it pushes up large, a very, very bullish candle. So you're thinking about holding on to this trade and you're already short in the market. You're thinking about doing that stupid retail trader, moving your stop loss, etc., etc. But when you see a massive candle like that come through, you're thinking, there's no way I'm holding on to that trade. And so therefore you get out of that trade. And it's usually at that very moment, and this has probably happened to many of you, is that moment when you close your trade or the moment that your stop loss gets hit is when you then see the big sell-off. But the reason...
It's happened to me many times, by the way.
The reason that is happening is because it's doing a few things. It's scaring the shorters who have jumped in the market here, seeing that double top, put the liquidity here, it's scaring them out of the market. So even if you're thinking about holding on, you don't have your stop loss there, they're going to be too spooked, too scared and think, shit, this is taking off, I need to get out of the market. But just as that's happening, most retail traders are now going long here, just like we were just saying. So they're now going long because they think that this level of resistance has broken. Loads of long orders come in the market. The liquidity goes below here. There's all the stop losses. And then what often happens as well, like what you were just saying with the wicks, what often happens next is this next candle will also be very, very bullish. And then, 1, 2, 3, this will look very, very bullish. And anyone who is stupid enough to trade without a stop loss and think about holding on because they want to see what the next candle is going to do, it starts pushing up. Say this is a daily candle. At one point, this will be very, 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 very bullish. And they think, shit, like this really is taking off. I really do have to get out. And then buyers who are waiting for a break of this candle here to confirm their buy, they're thinking, I need to get in, this thing's going to take off. They put their liquidity below here or below here as well. But what happens by the end of the day, that candle, more often than not, turns into that wick. And then the next candle, the next day, goes boom.
Yeah.
And takes out liquidity here and here. And the next thing, you've got an evening star formation. You've got 1, 2, 3. Price wipes it out, and then it starts going down, even lower down into these regions to take out the liquidity.
I would also add to that as well. Again, I've done this many times. From the very, very beginning days, I would either remove the stop loss. If let's say I took a short there, I would either remove the stop loss entirely and be like, it's not going to go that much higher.
We've all done that. We've all done that at some stage.
Or I would keep moving it higher. But one thing, thinking back to myself, which I'm sure many of you could relate to if you're newer or you've just been doing this anyway, is normally at that sort of point when you either get your margin called, you get liquidated, you go long. Once that trade closes, you go, well, fucking hell, the momentum is incredibly strong right now. I'm going to join the bullish side because this is seemingly not going to stop. And that's what also contributes to a much larger volume in this area. It's once that gets taken, and these people that got in from these regions normally reach that squeezing point of no return, that's where they also switch into a long bias as well, especially apparent in crypto because people are very reactionary, which will bring me to a following point after Bernie's done.
Yeah, I think what you just said is probably good. I don't know if you're going to lead on to it, but the squeeze. I often talk about the squeeze, on a day-to-day basis and then on a higher time frame basis when certain things are going on in the world, like calling the bottom of gold and oil and stuff like that. But there's often a squeeze factor. But on a day-to-day basis in this example, this is what you would call a squeeze. And it's just as Tori said, it gets you to that breaking point where you flip. We've all been there. The reason we know about this and know how to talk about it is because we've been there, done it, bought the t-shirt many times over. But, then you realize, like I said, many people say, well, where do you get sniper entries from? Well, it takes 6 months or a year of getting stopped out, placing stop losses here and getting stopped out. Obviously, this isn't the only thing, but, it gets your mind thinking, well, hold on, why do I keep getting stopped out? And it's realizing that the market is manipulated, like we're explaining now. Once you realize the market is manipulated, you realize, okay, well, I don't want to be entering anywhere here. I want to be waiting to up here. Then when you start combining that with trend lines, key levels of support and resistance, other formations, and, other things that we teach, then it all starts coming together. But again, just go back to what you said about the squeeze. It's when it brings you to that breaking point where, you're too scared to hold the short. And we've probably all been there where you've been short in the market, and it's the moment that you close out for a big loss that the market then goes into what would have been profit. And then you say, oh, if only I held a bit longer, I would have been in profit. The market's making you do that, so the next time you do hold longer and it obliterates you completely. But then, as you said, it's then also at that breaking point where you say, I'm not going to hold this short anymore, I'm going to flip to long. And you go long because this candle at one point was so bullish, but then at the end of the candle, it pulls back down and creates that wick. And then it's that squeezing point. And it's, it's one of the wonders of trading, I think. Especially, crypto is a lot more emotional, I think, but Forex as well. But this is the fact that this is so simple. Support and resistance, I think when I've done a course lesson for members, it was one of the biggest game changers. But it's something so simple, support and resistance. It's not just this, there's a few different things to it, but it's just so simple, and it's just amazing that this happens on every time frame, every day, day in, day out. Or if you look at this on a 15-minute, 30-minute, even 1 minute, 4-hour daily, and then in crypto as well, when you talk about these significant levels and how it just manipulates so many people. But then, what you just explained on crypto, on Bitcoin, it's very easy in like a few weeks after the event to look back and think, oh, that was so easy. It was
so obvious, yeah.
But it's the emotion at this time. But what you got to do is not go back to one of our psychology videos, is don't let the candlesticks, unless you know that these are manipulative like we teach, don't let the candlesticks, create that emotion and make you not see the market for what it is. Because at the end of the day, no matter what level it is, no matter what price, resistance is resistance, support is support, and it's usually within a range, and it's just taken out. This is what happens. I'll pass on to you.
No, it's fine.
But this is what happens day in, day out. I said resistance is top of a range of resistance, bottom is support. What price, whether it's moving from a 15-minute to a 1 hour, 4 hour daily, but continuously, what price is basically doing is taking out liquidity from a higher of a range, going back down to the bottom of a range, and going back up to the new higher of the range up here, and then going back down, and it's just continuously doing that and expanding ranges. Once you understand that, that should stop you getting your stop losses hit by at least 50%.
Yeah, I just want to add to that as well, because something very interesting Bernie just mentioned, which can absolutely just tie into another crypto example, is if you were to imagine this candle here as being, again, that 125K all-time high that we saw, Bernie made something very clear here. It doesn't matter what size it is, where it is, what price it is, nothing. But narratives play a significant role in crypto as well. So the bigger that candle becomes, what you begin to see is something like the highest daily close ever on Bitcoin, the highest weekly close ever. All irrelevant. Forget the narratives and look at what's actually taking place. When you see a lot of these things here, it'll hopefully remind you of why these things are happening to you. Hopefully it kind of hits home and you go, oh shit, I do that. Maybe that's why. Because the truth is, a lot of us feel like victims in the market, and we almost get that feeling that the market is purposely hunting us. That's not the case.
But it's because it is. Because as a retail trader, you are being falling victim.
You feel like it's a personal attack. You're like, is the market, does it know where my stop losses are? And it does, that's the truth. Yeah. But it's not you as an individual, it's the collective herd. And as retail traders, we're powerless in individual circumstances. Your singular stop loss, no matter how big your account is, whether live funded, whatever it may be, you are powerless. We are all powerless. But in collective herds, all of that liquidity generated is very, very powerful. And that's what market makers and the market as a whole, from the algos, etc., will seek. The highest liquidity and highest volume areas. So you must then understand, when everyone is generally looking at the same thing, these candles and the market itself is deceptive. It's leading you to execute these positions based on all of these little factors that we are taught or think we should be doing to then bring everyone into the same areas. And this is very common in crypto specifically, if I just remove this quickly, sorry Bernie, I need to tiptoe.
Okay, I don't like it anyway.
I will now show you a very simple example of where a lot of people go wrong in crypto.
Let me get the higher bits.
Oh yeah, sorry, I just tiptoe. There we
Might
go.
need some help.
So the simple concept again also is with crypto, unfortunately, we have access to 100 times leverage, 50 times leverage, 70 times, etc. And most people really react and are reactionary simply to the color of the candles and the size of the candles. And one thing you will commonly see, even in a very strong uptrend, is generally if people see this sort of candle, which we'll just show this, and then people see this candle, two things happen. Let's just say in individual circumstances, like this. What most people will do is generally, and sometimes I can't believe this is actually how people react and trade. The minute that candle closes, long. Stop loss below there. And especially when using liquidation levels as a stop loss, which is unfortunately very, very common in crypto, a lot of people do not have control over where their actual stop loss placement is. But what most people commonly do, even in an aggressive uptrend, the minute that candle closes, similar to what Bernie showed earlier, it can possibly pop through the high first. But what will normally happen, even in the most strongest of uptrends, is the market will generally pursue a move down to wick through at least a low of that candle before it ends up proceeding higher. The same is applicable to the downside. People will go short right here and place their stop loss just above that candle high. And even in the strongest of downtrends, the market will very frequently just pop through that level. And if it doesn't do it in the following candle, it will likely do so even if it goes lower to come back thereafter. And generally, the larger the candle, the stronger the candle appears with less of a wick, the more it becomes a so-called easier place to place your stop loss. So again, it really goes back to the idea of, is the market giving it too easy to me? And generally, when the market makes something seem too easy, too simplified, you then know you're tapping into the collective consciousness of where everyone else is likely thinking the same thing. A little tip would probably be to view, before you actually execute a trade, view yourself trading from a third person standpoint, as if you're viewing yourself trade from behind, and look at how you are reacting to certain things within the market, such as the double top, such as the bullish and bearish candle, such as the bullish engulfing, bearish engulfing, the morning star, evening star, even the dojis. You know, most of the time when you see a doji, it's a clear sign to stay the hell away from the market. Let something else happen. And the doji is a great example of how the market, in many circumstances, will attack both traders, especially when you see a collection of dojis. Now, for me personally, when I see a doji, whilst it can indicate, let's say you see a candle like this, it can indicate that something very big is about to happen or the market's in an indecisive period. People will try and trade this. And what you must realize is with a doji, there's literally stop losses and liquidations accumulated on either side. And what most people will try to do here is try to guess the directional breakout of that doji. But more often than not, the best thing to actually do is wait for one side to get taken out first. And what you'll normally see is if the market is going to continue lower, let's say the market's been moving like this and reaches into an area like this, and you reach this doji point. If you're going to proceed, also quite important to mention, it depends where this stuff happens. What a lot of people forget to realize is do not look at individual candlestick formations on their own, I would say.
Yeah.
It's where these things form that is most important, and as equally as important as the formation itself.
Like a support or resistance,
Yeah.
or when it reaches a trend line point, not just
Yeah.
in the middle of a trend.
Yeah.
You got a doji candle, it's not going to mean much.
Yeah.
But if you get a doji candle at a level of support or resistance or at a touch of a trend line, then it means something.
Yeah. Like say here as an example, that's the actual support where you've seen loads of price action on a weekly basis like that, or monthly, daily, whatever. If price is not yet at a key region, you especially do not want to be making many decisions on this basis. What you do want to do is ideally follow the overall trend and trade, if you're going to be intraday trading, into the key level down below. And what would normally happen in that circumstance is once that closes, people see wicks as a reversal signal, but it doesn't necessarily mean that's the case. So someone would then see that wick form there and go, I'm going to go long. Put the stop losses below or the liquidations, and the same applicable to the upside. What you need to do is wait for one side to get taken out first, because it then makes life easier and also increases the probabilities in your favor. So as an example, the following candle drives down first and takes out that doji low. You actually have a higher probability of succeeding from there to then capture the move up to the high of the doji after. Because the following candle could still be a doji, but if it takes out the low first, it still has that remaining down below. Simultaneously, as that gets taken out, it's probably going to increase the liquidations up there as well. Then the next thing I want to mention is what's currently going on in crypto. And what I think is likely happening is I'm anticipating a reversal to the upside. And the one thing to do in crypto is when the market begins to give some form of indication there's a recovery, you want to look at what the market is actively doing and look at the behavioral patterns. Now, one thing that's different in crypto right now is since the 10th of October liquidation event, we've seen at this point in time almost $20 billion in liquidations. FTX and COVID were like $2 billion. We've seen the most liquidations ever. That already tells you the market is pursuant in liquidating longs. Most of those liquidations are longs. That's already given you a bit of an indication that the market as a whole, from this whole move down, are now beginning to make some form of recovery, which I'll start from here. First of all, from this point, this whole move has been a pure long liquidation spree, targeting all these longs, blah, 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 swept. At this point, it's intentional in crypto specifically, where the market is predominantly greed and fear based, heavily, heavily psychological, just like Forex, but crypto's just worse for some reason. It's cleared everyone out. So you already know there's a chance here the market is actively pursuing longs for a much larger recovery to the upside. What normally happens in these situations is people have been so significantly obliterated that morale begins to change and the likelihood of a recovery is diminished. So longs begin to diminish in the process. So when the market begins to create a recovery, and we saw this recently where BTC went from 80K back towards 90K. When the market gets a little glimmer of hope, what is the first thing it did? It slammed all the way back down to the exact lows and then recovered further back into this region. Now, when you begin to see patterns like this, if you see a very significant move down like we've seen in crypto, it does also mean in some circumstances, it won't take out the low until much later down the line. And that is heavily dependent on how big the move down has been. So if the whole move down has been so severe, what it generally means is it doesn't always need to come back down to after. And what this normally begins to represent is when you start to observe patterns of, let's say, the market suddenly dumping and recovering like that, or dropping down and recovering like this, the more attempts you see to the downside, what that normally begins to represent, especially since ETFs, is that liquidations are not just being triggered in these regions with these sharp drops down, but it also begins to represent institutional buying. And very frequently what we've been seeing recently is almost immediately when that US session begins, the market immediately slams down, immediately slams down, immediately slams down, slams down. But what it's beginning to do is the sharper moves to the downside. Very important to note. The sharper moves are moving into the downside, but the recoveries are slowly going higher like this. And what this normally means is this is where institutions are using, number one, that little glimmer of hope left from long positions to liquidate, which is causing a miniature cascade. And what they're actually doing in these regions, when they're doing this, is accumulating large and large sums for their balance sheet. Because as things begin to progress, that little low liquidity volume of longs left is allowing the market to drop more. But if it's quickly counteracted, what you're actually beginning to see here is large institutional buys that begin to take place in a certain region. And I hope that's making sense. But what most people fail to realize is institutions are buying, and Wall Street especially, funds, whoever they are, they're buying in the billions, in the hundreds of millions. So when a bottom is beginning to form, they are using any form of opportunity they can get during high volume areas and low volume liquidity areas to acquire as much as possible. And this is normally a double whammy. It's not just liquidating the final longs out of the market before, again, the market likely proceeds higher, but it's simultaneously taking advantage of these traders to create that sweep to accumulate more at a slightly better price. And this is very likely what we are seeing right now in crypto, because the sentiment's been destroyed so bad, most people are getting stopped that they're not willing to go long. But what you must remember is a move of this nature that's liquidated all of these moves, all of these longs, also has had, just to continue here, very few upside moves along the way down. So if I clear this off and just continue from that point, the next thing to mention is a strong downtrend to continue with that. When you start to see less and less recoveries and the market begins that bottom period, what you must remember is the longs from here, of course, have all been swept. So all of the longs that were liquidated from this region are gone, 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 gone. So sentiment and morale is finito. But what's also happening with every single drop down is traders look at this and go, this is the easiest short in the world. This is easy. Follow the market, follow the trend. The steeper this gets, below all of these, or above all of these highs, is basically a ray of liquidations that goes the whole way down, specifically from where those big red candles come through. And when you see the market begin to break down from a key level with a little miniature swing, that's where the most liquidations and stop losses will be placed. And this is where we recently saw that recovery back to 90K. It's psychological in nature and people use round numbers as well. So as we got that break from 90K here to 80K, because it happened with such aggression, all of those liquidations and stop losses would have been exactly as this momentum candle came down. And people place all of their liquidations there. So what you're now likely beginning to see from a recovery basis is bit by bit, all of these begin to come back through and the market pursues all of those. Because very rarely do you go into a bear market, or very rarely do you see a major trend come through, making it that easy. That's normally what happens, and it's kind of similar to the all-time high situation we mentioned as well. So for a crypto-specific base, you want to take this into consideration because the market may move temporarily in a straight line, but it very rarely will do so without coming up first to liquidate all of those people that think they have an easy ride and then continue down from there.
As Tori has used a real life example, I'll just give you, for those watching the video, at this time of it going out, we've actually got FOMC tomorrow in Forex markets. It's a very important time for the US dollar index. And when we returned back to YouTube at the start of the year, I actually called that the dollar index would die, that the US dollar would die. And that was in January. We haven't stopped falling since January. So we called that in January, go back to some of our videos. And the way I called that was exactly what I just showed you. And I've shown that in a video on ranges as well. So it was basically, as I said, if you look at different time frames, you'll see that the market is normally in a range. And what we noticed was that the US dollar, the index, the DXY, the Dixie, that was in a monthly range. So there was a monthly range where price had prior had hit that high, we'd pushed up, big bullish engulfing candle, literally what I just drew on. If you go back to January of this year and look at what I've just drawn, what we spoke about today. And then that was December, and then January was that candle. Funny enough, it is, I think, exactly what I just drew out. I didn't mean to do that.
I actually remember.
I didn't mean to have the comparison, but that's what we look for. But that is actually what happened on the dollar index, if you look at the monthly time frame. So then in December, no, that was December, I think. And then I think January, we then started dying. And we're now down here. We're basically down here on the dollar index. So we've taken out the low of that range. But since we got into this area, we've got into a new range, which I'm now going to clean this off and just explain to you now and what to look for. Because, you know, if you understand what I'm going to talk about now and what could happen over the next few months or next few weeks, you know, we're talking about the start of the year, we're down here now. We could see there's no reason, most people think we're crazy, but when it comes to ranges, there's nothing to say that price can't go from here all the way back up to here, because it's simply a range. Forget about the narratives. At the top of a range is resistance, at the bottom of a range is support. That's what you got to do. That's why the narratives are what makes it so difficult at range highs and at range lows and support and resistance. If you just look at price action for what it is and understand how it really works, like we're explaining, it can be so simple. But everything else gets involved. You know, crypto news, there's a lot more crypto news, but Forex news about how weak the dollar is or what's happening with the dollar. But you can just imagine we're at the bottom of that big monthly range that I just spoke about. But the last 3 or 4 months now, I think we came down with a bearish engulfing candle on the monthly time frame, which hit a trend line on the dollar index, a monthly trend line. Then immediately we had a bullish engulfing candle to reverse that. So that was bullish. No, sorry, I won't color them in. That was bearish. That was bearish. This was bullish. And then since then, we sort of, I can't remember the exact layout, but we're sort of something like this on the monthly time frame. At the moment, at the bottom of that overall monthly, there's now a new monthly. I can't remember if it's 3 or 4 candles off the top of my head, but we're basically in this area now. And what's happened is we've created, on the monthly time frame, we've created that double top, we've created that double bottom. So there's a lot of liquidity up here, and there's a lot of liquidity down here, and both have to be taken before the real move happens. So we've got FOMC coming up. I don't know if FOMC will do it. We're in December, you know, a little bit less volatility. I said I can't remember the exact way that this is. I think this is the current monthly candle. But what I predict is that, you know, we're likely going to come down, take some liquidity from here, then make that move up to take out this liquidity here, and then have that move back down, take out all of this liquidity here, and then go all the way back up again. If this happens, there's some huge moves. You know, this is the monthly time frame. So we're talking at like 20% move up to here. We're talking about 30-40% sell off down to here. And then this move going into the 50%, like 50 to 1 risk reward, or 10 to 1 risk reward at these little moves here. It doesn't necessarily have to happen that way. Like it could go, you know, we've got liquidity below here, below this level of support. We've got this resistance on a monthly time frame. This monthly candle, without taking out this low, might push up on FOMC and take out that high. But what we're showing you is, if that happens this way first, that's the short entry to come down to here, because that's where the liquidity is. And once you get that short entry down, then there's going to be a huge long trade on the dollar. So you can either go that way first, where it goes up to take out the liquidity first, above this. That's the range. So it could go up here first, but this week, and we've got a long time left in December, we might come down to try and take some liquidity from here first and then make that move back up. But whichever way, you just have to be patient and wait for price to come to you. Even worst case, if it did somehow slam straight down here, that's your trigger for it to buy and go back up to this high and then even higher. So it's just waiting for identifying those double tops, those double bottoms, and you know, even here, so there's 2 highs on the monthly time frame. If you look at the current weekly or monthly time frame, if you look at the date, if you're watching this in the future, but if you look at today's date and look at the chart, we've got an old double top on the weekly on the dollar index, but we've recently come up and made another double top like this. This is very obvious what we spoke about today. It's so obvious, it's such a obvious formation to see that there's a very high chance of price going back up to take out that high. So it's currently, at the time of speaking, at the bottom here. So it's manipulating orders in the market at this double bottom, and it's likely going to sell off and push back up. But that's just a real world example I thought I'd throw in the mix. But yeah, understanding support and resistance, how it really works, that's a few pointers on it. Obviously, we can talk about this stuff for hours. Let us know what your thoughts are. We can cover more in the future, trend lines, different formations. But just understanding that straight away should help your trading massively to stop your stop losses getting hit.
Yeah, to add to that, I would say not just the third person trick, but apply what we've shown you here to help you have more patience in the market as well. Because by simply understanding this being one of the major causes of downfalls for your stop loss being hit, it will help you build more patience to understand that you want to wait for these particular things to happen. So as an example, the range high being taken out is your highest probability area to take a short. Simultaneously, if the range low gets taken out or the level of support and resistance, that's your goal, to look at the market and go, hold on, this hasn't happened yet. And like Bernie said, just to quickly illustrate before we wrap up as a kind of final pointer, don't enter there. Don't enter there. Wait for the market to always do something of this sort, even there. Wait for something of this nature between these levels to increase your probabilities. And also view the market from a whole different basis. Not just be patient, but pretend your job is not the trader, but pretend your job is the hunter. You are the one that's hunting the stop losses.
Sniper.
And a sniper. You instead, your goal is to find where those stop losses are and where those liquidations are in the market, and treat yourself as the manipulator and the market maker. And by doing so, it will allow you to have that kind of bird's eye view and third person approach of the market to almost observe it and monitor it from the background and go, well, actually, what is everyone doing right now? That's the question you should always ask yourself. What are most people doing, seeing, thinking, and feeling in this area? And when you do that, whilst observing how you feel in this moment, sometimes theoretically imagine what you would do here. And it would likely be short here to place a stop loss there. And instead of doing that, do nothing. Do absolutely nothing. Wait for it to come back. And this is kind of the key, isn't it? All of this comes down to the patience of waiting for it to unfold, because greed will consume you. You want to be in the market. You want to take these trades. You want to react impulsively because you're just constantly thinking of money. But you're likely losing more in the process by purely pursuing money. Because all of these things you see here are the consequences of people that are constantly looking for money. It's people that are trading in irrational areas, which are giving the illusion of rational areas before actually getting wiped out. And what is the most rational area to enter is once key highs and lows have been liquidated or candle highs and lows, etc., have been taken out. That's where the actual highest probability of a significant reversal takes place.
Yeah, and it literally is, like Tori said, try and think of it as a third person. Think, what is everybody else doing? What is the retail trader doing? Try and think of yourself not as a retail trader anymore. And just think, like, where is the obvious places? If you see a bearish engulfing candle, what is everybody else doing? Or what would the old you do? Or what do you do now if you're still making those mistakes? And as weird as it sounds, often to be a successful trader, you basically have to do the opposite of what your instinct tells you to do. Because your instinct is made to, feed off these formations that you've been told work, or the candlesticks. When you see red, you sell. When you see green, you buy. It's just instinct. And a lot of it comes down to basically doing the opposite of what your instinct tells you, until you do that long enough that that becomes your new instinct. But going back to what you just said, where you just finished off, the best places to take a trade is at the top or the bottom. The other reason why you don't really want to be taking these trades, sometimes they can move faster. And the reason for that is to trick you, to create FOMO. But I said this on a video yesterday, so it's just fresh in my mind. But basically, you want to see liquidity as basically the catalyst for a trade to start. Or like, if you think from down here, the rocket fuel. For a trade to really, if it comes down here, for something to take off, it needs fuel, like fuel for a car. I don't really want to be taking a trade here because it's not really going to get that far. It might come down, it might create a few bearish candles to create that liquidity, but if it goes up here and takes liquidity, it's got the fuel for the car to make that journey down, not go halfway and stop and come back up. So it's like the liquidity is what gets the trade moving. Once you get that liquidity, then you can see that trade start taking off and start hitting those big profits.
I actually tweeted something, I think it was like 2-3 days ago, just to add to this as another pointer. I said the space shuttle does not take off until it clears all the debris first. And when a spaceship is obviously about to launch, the explosion down below blows everything out the way first. And that's how you could almost envision it clears all the debris, which is the liquidations and stop losses and liquidity, before taking off in either direction as well. So the core of it really comes down, as always, to patience and having self-control.
Yeah, but obviously patience comes from understanding. If you don't understand what we just said, you're never going to know to have patience to wait. So we hope that, I think it's a very, very big thing that we covered today. I think we can break it down in a lot more detail as well, but we have, broken it down in a nutshell. But it's so important. It's such a game changer if you really understand this. And, because if you don't understand this, then you can have the patience of a saint. But if you don't know that price is going to go for the drive up and try and take liquidity, what have you got patience for? You don't know what you're waiting for. So you need both and then merge them together. You need to know what you're looking for, but then have the patience. If you know it's going to happen, a high probability of the time, then don't be stupid and jump into a trade. Just wait it out and have patience.
Yeah, definitely. If you now have this knowledge from this video that this stuff will happen, just control yourself next time and just withdraw yourself and restrain from actually taking that trade that you instinctively want to trade. Wait for something like this to play out, take a trade on that basis, and I guarantee you there's a much higher probability it will work out. But like Bernie said, we can go into so much more detail, and we want to ask you guys to leave a comment So let us know what you want next. We're going to do individual ones with Forex, crypto, joint ones. There is so much that can be discussed, as you've probably seen from some of the previous videos on this whiteboard as well. So you guys let us know what you want covered next, and we'll make sure we get it done.
Thank you guys. Hope that helps.
Thank you very much. See you in the next one.